Atlantic City had 12 operating casinos in 2006. It had 7 by 2016. 5 casino properties closed within a 24-month window between 2014 and 2016, a pace of institutional collapse that no American gaming market had previously experienced, and that the regulatory framework governing casino licensing in New Jersey had not been designed to manage. The Atlantic Club closed in January 2014. The Showboat closed in August 2014. The Revel closed in September 2014, having operated for only 26 months after opening at a cost of $2.4 billion. The Trump Plaza closed in September 2014. The Trump Taj Mahal, documented in case file 014 of this channel's archive, closed in October 2016. 5 properties, 5 closings, 1 market, 1 decade. The forensic entry point for this case is not any individual casino's capital structure, ownership failure, or operational deficiency. Every individual casino that closed during this period had its own specific financial history, its own specific ownership decisions, and its own specific reasons for being unable to sustain operation in the Atlantic City market of 2014 and 2015. The forensic entry point is the market itself, the structural conditions that made Atlantic City simultaneously unable to support the supply of casino gaming it had built and unable to reduce that supply fast enough to prevent the cascade of closings that the market's structural deterioration eventually produced. Atlantic City's casino market had been built on a regulatory monopoly that New Jersey had created in 1976, when voters approved casino gaming as a mechanism for urban redevelopment of a declining resort city. That monopoly was the foundational assumption of every financial projection that had justified every casino construction project in Atlantic City, from the opening of Resorts International in 1978 through the Revel's opening in 2012. The monopoly eroded progressively as neighboring states legalized gaming, beginning with Delaware in 1990 and accelerating through the 1990s and 2000s as Pennsylvania, Maryland, and New York introduced gaming facilities that captured Atlantic City's regional captive market one state at a time. The structural delusion at the center of this case is the collective failure of the Atlantic City casino industry, its regulators, its lenders, and its ownership groups to price the erosion of that monopoly as a permanent structural shift rather than as a temporary competitive disruption that Atlantic City's established brand position would eventually overcome. Every major capital investment in Atlantic City made after 1995 was premised on a market that the surrounding state's gaming expansion was systematically dismantling, and the dismantling proceeded on a timeline that every major capital investment made it more difficult rather than less to absorb. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The Revel Casino Hotel is the forensic anchor of the Atlantic City market collapse, not because it was the largest or the most historically significant of the 5 properties that closed during the decade of demolition, but because it represents the most precisely documented instance of the structural delusion at the center of this case, a $2.4 billion investment made in 2012 in a market whose structural deterioration had been visible in the regulatory and competitive data since at least 2006. By an ownership structure that had concluded that a sufficiently differentiated product could recapture market share that neighboring states' gaming expansion had been extracting for 2 decades. The Revel's capital structure combined Morgan Stanley's initial investment, subsequent debt financing, and a New Jersey government incentive package that had been assembled on the premise that a luxury non-smoking gaming resort would attract a premium demographic that Atlantic City's existing casino inventory had not been capturing. That premise was not unreasonable in isolation. Atlantic City's existing casino inventory was aging, smoking permissive, and positioned toward a demographic profile that was not growing in the regional market. A luxury differentiation strategy had theoretical merit in a market that had historically competed on price and volume rather than on quality and experience. The covenant that the Revel's ownership did not read carefully enough was the one written into the fundamental economics of casino gaming in a market whose total gaming revenue pool was contracting. A differentiation strategy requires a market large enough to support both the differentiated product at its premium pricing and the undifferentiated competitors at their volume pricing simultaneously. The Atlantic City market of 2012 was not that market. Total gaming revenue had declined from a peak of approximately $5.2 billion in 2006 to approximately $3 billion in 2012, a contraction of more than 40% in 6 years that the Revel's opening did not reverse and that its differentiation strategy could not address because the contraction was not caused by insufficient product quality, but by the geographic redistribution of gaming demand to facilities that were closer to the regional population centers that Atlantic City had historically served. The Revel filed for Chapter 11 bankruptcy in March 2013, 7 months after opening. It filed again in June 2014. It closed in September 2014, having never generated sufficient gaming revenue to service its debt under any operating scenario that its management had been able to implement. The $2.4 billion investment produced 26 months of operation and a distressed auction that recovered cents on the dollar. At what point does a differentiation strategy in a contracting market become a structural delusion rather than a calculated risk? Leave your analysis in the comments below. The appraisal methodology applied to Atlantic City casino investments across the decade of demolition shared a foundational error that this channel has documented across 19 case files, but that the Atlantic City market expressed with the geographic specificity that makes this case uniquely instructive. The failure to price the erosion of a regulatory monopoly as a permanent structural change rather than as a temporary competitive disruption. Every appraisal of every Atlantic City casino asset conducted between 1995 and 2012 was built on a total addressable market projection that assumed Atlantic City would retain a share of regional gaming demand that the surrounding state's gaming expansion was progressively reducing. The magnitude of that reduction was not hidden from the appraisers who produced those valuations. Pennsylvania's gaming revenues alone exceeded Atlantic City's total gaming revenues within 5 years of the state's casino opening, a comparison that required no complex analysis to produce and that was available in publicly reported Gaming Commission data. The appraisals incorporated that data and produced valuations that discounted it rather than weighting it as the primary input. The specific discount mechanism used to explain away the Pennsylvania and Maryland gaming data was the brand argument. Atlantic City possessed a coastal resort identity, a critical mass of entertainment and hospitality infrastructure, and a brand recognition in the northeastern regional market that the inland Pennsylvania and Maryland gaming facilities could not replicate. The brand argument was not wrong in its identification of Atlantic City's competitive advantages. It was wrong in its quantification of those advantages as a sufficient offset to the geographic convenience that inland gaming facilities offered to the same regional population that Atlantic City had historically captured. The Revel's appraisal carried that error to its logical extreme by adding a luxury differentiation premium on top of the brand offset, producing a stabilized revenue projection for a $2.4 billion investment in a market whose total gaming revenue had declined by 40% in the 6 years preceding the investment. Independent gaming analysts who reviewed the Revel's financial projections identified the total addressable market assumption as the primary source of appraisal risk. The projections were not revised. The investment proceeded. The market delivered the outcome that the total addressable market assumption had made inevitable. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The structural delusion documented in this case file is collective rather than individual, distributed across every participant in the Atlantic City gaming market who made capital allocation decisions after 2000 on the assumption that the market's competitive position was recoverable through product improvement, regulatory advocacy, or operational excellence. That assumption was not the product of ignorance. The data documenting Atlantic City's market share loss to neighboring states was available to every participant who chose to read it. The assumption persisted because the incentive structures of the parties making the capital allocation decisions consistently rewarded optimistic projections over accurate ones. Casino operators seeking regulatory approval for expansion projects presented optimistic market projections to New Jersey regulators because optimistic projections supported approval and pessimistic projections did not. Lenders underwriting casino financing presented optimistic stabilized revenue projections to credit committees because optimistic projections supported lending and pessimistic projections produced deal attrition. New Jersey regulators approved expansion projects because the casino industry's tax revenue contribution to the state budget created institutional incentives against approvals that would have reduced the industry's capital investment. The New Jersey Casino Control Commission, whose mandate included ensuring the financial stability of the casino industry it regulated, approved licensing applications for new facilities and significant capital investments in existing facilities through a period during which the market data clearly indicated that the industry's aggregate revenue was insufficient to support its existing supply, let alone expanded supply. That regulatory failure is the most forensically significant element of the Atlantic City case because it represents the systematic failure of the institutional mechanism that was supposed to prevent exactly the outcome that occurred. The New Jersey gaming regulatory framework had been designed to ensure that only financially viable casino operations received and retained licenses. The framework's application during the decade of Atlantic City's structural deterioration produced the opposite outcome. The continued licensing of facilities whose financial viability was progressively undermined by a market contraction that the regulatory body was documenting in its own revenue reports while approving the capital investments that the contraction made unsustainable. The 5 closings of 2014 and 2015 were not regulatory failures in the sense of unlawful or corrupt action. They were the predictable output of a regulatory system whose incentive structure had aligned against the exercise of the judgment its mandate required. The Atlantic City gaming market stabilized after 2016 at a level of supply that its remaining revenue base could support, a stabilization achieved through the involuntary exit of 5 casino properties rather than through any planned capacity management that the market's participants or its regulators had engineered. The 7 casinos that survived the decade of demolition operate in a competitive environment that the contraction has made more rational than the 12 casino market of 2006. In the specific sense that the remaining properties are less severely disadvantaged by supply-demand imbalance than the properties that closed had been. The rationalization was brutal, involuntary, and enormously destructive of capital. It was also, in the forensic framework of this channel, the inevitable resolution of a market that had built supply on the assumption of a regulatory monopoly whose erosion had been underway for 20 years before the 5 closings made it undeniable. The Revel's physical structure was acquired out of its bankruptcy proceeding by a Florida developer who proposed multiple redevelopment concepts, none of which has been realized as of the time this episode was produced. The building stands on the northern end of the Atlantic City Boardwalk, structurally intact, physically preserved, and commercially inert, the most expensive monument to a structural delusion in the history of American casino development. The Trump Plaza was demolished in February 2021. The Showboat was converted to a non-gaming hotel. The Atlantic Club site was redeveloped. The physical evidence of the decade of demolition has been partially absorbed by the urban fabric of a city that is still processing what the loss of 5 casinos in 2 years means for its economic identity. What the Atlantic City case reveals about the broader pattern of institutional failure documented across this channel's 19 case files is the specific amplification effect of collective delusion over individual delusion. Every previous case file has documented an individual ownership, a developer, a private equity firm, or a sovereign wealth fund that made a specific error of financial judgment. The Atlantic City case documents an entire market that made the same error simultaneously, reinforced by regulatory incentives that rewarded optimism and punished accuracy, producing a collective failure that no individual actor could have prevented and that every individual actor contributed to. If this case file changed how you evaluate the relationship between regulatory incentive structures and market supply rationalization in the American gaming economy, subscribe to this channel because the next case examines what happens when a single actor in a market decides to price the structural reality that every other participant is denying and what that pricing decision costs. And in the comments, given the New Jersey Casino Control Commission's access to the market revenue data that documented the supply-demand imbalance throughout the decade of demolition, what specific regulatory mechanism would have produced the capacity rationalization that the market eventually achieved involuntarily? The case file is open.